Have you ever wondered what impacts your credit score? Well, there are 5 key factors. Factor 1 is payment history. Do you pay what you need to pay and pay it on time? This accounts for 35% of your score. Factor 2 is credit utilization. This is the amount of revolving credit, like credit cards you're using, divided by the total amount of revolving credit you have available. This accounts for 30% of your score. For example, if the sum of the credit limits across all of your credit cards is $5,000 and you owe a total balance of $2,500, then your credit utilization ratio is 50%. A credit utilization ratio of 30% or less is often considered good because if you're using more than 30% of your available revolving credit, it could indicate that you're financially stretched and relying too heavily on credit and negatively impact your credit score. Factor 3 is the length of credit history. So this accounts for 15% of your score. This looks at both how long you've had established credit and how long since you last used it. Companies want to see that you have a long history of using your credit responsibly. Factor 4 is new credit. So this accounts for 10% of your score and refers to the number of new accounts you have. So opening too many new credit sources in a short period of time can lower your score. Factor 5 is credit mix. So this accounts for 10% of your score, and it is the various types of credit you have. For example, credit cards, retail accounts, installment loans, and mortgages. What's a good credit score? Well, generally a score of 670 or above is considered to be good, while anything 580 or below is considered poor, and 800 or above is exceptional. Don't know what your credit score is? Well, some ways to find out your credit score for free are to get it from your credit card issuer, so check your online account or app, from a loan statement, or from a credit monitoring service like Credit Karma, which is free.